Good afternoon, everyone. Great to be back again. I'm Rajeev, and through this series, we aim to shed some light on the global macro and investing landscape, which is particularly pertinent given the high amount of uncertainty and volatility we are experiencing currently. Investors got some positive news as inflation fell sharply to a two-year low. As of May, the annualized rate of CPI has declined for 11 months straight to 4% in the US. However, today's speaker, James, believes that inflation will be a structural force in the economy over the next few years. So we'll explore that. Meanwhile, the NASDAQ has now had the best start of the year for almost 30 years with a growth of almost 30%. And, other markets, including the Indian stock markets, are at an all-time high. So the question is, what gives? To answer that, we have with us James Davolos of Horizon Connects, a fated and awarded investment advisory firm. James's investment thesis revolves around the asset-heavy capital light model. That's intriguing, James. I would like to know how you can be asset-heavy and capital light at the same time. And he manages portfolios which are expected to benefit in an inflationary environment. James has been named one of the best top fund managers of 2022 by the Wall Street Journal. Today, he will talk about his investment strategy, where we are in the asset and capital cycle, and what this means for one's portfolio. I'm really looking forward to it. So I'm going to request James to take the center stage for about 20 to 30 minutes. We will obviously share notes because, we'll make the conversation available after, and we'll move to a Q&A. Please, if you have any questions, type it into the chat. We'll definitely get to them. I look forward to a productive 60 minutes. James, over to you.
Thanks, Rajeev, and thanks everybody for spending some time with us today. So the presentation that I was going to use today is basically going to highlight what I and my firm believes were some anomalies that took place over the past 20 to 30 years that largely influenced capital markets. And this is really important because especially in modern financial markets, many people who model markets are only using 10 or 20, maybe at most 30 years of data, generally because of a data availability issue. But as you'll see as I go through this presentation, we believe that much of the past 30 years was an anomaly, not actually how the market and the economy works. And that's going to have profound differences going forward. I'll bury the lead and cut to the point here, but I think that after an era where you could basically just buy an asset class, whether it be large cap growth stocks or bonds, and do quite well in indices, I think that era is over, and it's going to require far more discerning investment expertise because multiples cannot expand indefinitely, valuations cannot expand indefinitely, and most certainly we cannot go through another 30 years of interest rates declining with low and stable inflation. So with that, I'll pull up the inflation and kind of go through the thesis and exactly how we're going to tackle this challenging environment. As I referred to earlier, the long-term paradigm has been basically 30 years of generally low inflation, low and declining real interest rates, increasing profit margins, and rising productivity. All of these trends have been disinflationary and very supportive of financial assets. We believe that these factors are rapidly ending or reversing, which is going to be inflationary on a secular basis, but specifically for structural sub-industries. Now, this should not be confused with cyclical variables where you've seen a lot of cyclical mean reversion in inflation factors today. These critical hard asset industries include energy, metals, and agriculture. And critically, they've all experienced decades of insufficient supply growth, despite resilient and rising demand. And what the Western world really misses is that resilient and rising demand is now being driven almost exclusively by the non-OECD countries. And so throw in the variables of indexation, which structurally underweight these sub-industries, ESG concerns, and poor capital returns over the past 20 years. And we were basically setting up for a supply shock at the very same time that we're going to have a fairly strong and robust demand environment. So what we think this is going to lead to is elevated but very volatile inflation, and that has a lot of implications for interest rates and inflation. Conventional business models, I think, are going to have a difficult time to grow revenue in real terms. We saw everybody was able to basically grow their profit margins at the beginning of the inflation cycle. Now costs are catching up, and you've seen record profit margins basically come back down a couple hundred basis points in the US. A lot of hard asset industries that would theoretically benefit from this cycle are capital intensive. So those companies are going to be extremely exposed to this cost pressure. So on the bottom right there, you can see how do we solve this? And I'll go through these companies at the end, but you really need to have exposure to these hard assets. So energy, metals, agriculture, land, infrastructure, but through a capital light business model. So high profit margins, scalability, limited debt financing, long life assets, and of course, strong cash flow generation. So moving on to the next slide. Again, this is kind of a repeat of the last, but there's a new normal in the market that's really informing here, where we believe that even though inflation is moderating today, a huge factor here is that we're coming off of a very high base. So if you look at core CPI in the US, which excludes food and energy, that's coming back down in the 3 to 4% range. Maybe even it'll see 2%. But it's an oxymoron that they call food and energy non-core, where the average person, the biggest components of their consumption bucket are basically lodging, food, and energy. We're lapping off of very, very high food and energy prices, largely due to the conflict in the Black Sea region, Ukraine and Russia, which sent energy prices far higher and also had very big impacts on fertilizer markets and particularly wheat markets. Whether or not that situation is going to be remedied anytime soon, we have come down from those levels in no small part due to the release of the Strategic Petroleum Reserve in the United States, as well as kind of OPEC helping along with supply. Everything there has reversed. So as you can see here on the right, the structural drivers that we think are going to have very prolonged, important inflation drivers are energy, food, industrial metals, land, and infrastructure. Things that people think mean inflation is abating might be used automobiles, semiconductors, and capital goods. So it's really important to understand what is going to be the long-term driver, but then also, why are we going to go through a higher volatile inflation and rate cycle? We're seeing reshoring of supply chains. Very critically, the West has been importing disinflation, meaning cheap labor and resources, from Western non-OECD markets for decades. Now there's rising GDP per capita in those markets, and they're competing for those resources and labor. Meanwhile, we've exploited most of the cheap and readily available resources. Finally, this is a really important one. Productivity gains have stalled. So I'm sure in this community, with all of your technology exposure, from 1999 through 2010, productivity in the United States grew 3% a year, which is a 300 basis point tailwind to GDP growth. We have not seen anything like that, and that was basically a function of the internet becoming a business application. Barring something absolutely unforeseeable with AI, which unfortunately would displace a lot of labor, it's really hard to see productivity gains go anywhere near where we've seen over the past couple of decades. So again, this is the setup. Moving on to the next slide. I think this is the biggest limiting factor. So everyone can argue whether or not they think that there's a fundamental inflation problem, whether it's supply chain related, whether it's related to demand. Everyone's worried about a recession. Here's the biggest limiting factor. Net interest outlays in the United States are expected to reach $1 trillion by 2023. Every time that we roll this debt over, right now the average weighted coupon coming into this year was below 2%. Short-term T-bills are now over 5%, all the way out to the 2-year T-bill. So whether or not the government actually wants to combat inflation long-term, they cannot. Because again, how do you grow out of a structural deficit this large? The only way to do it is through real growth, and real growth requires growth in your labor force and/or growth in productivity. You're not seeing labor force growth in the US or any Western market, and productivity growth is just, it's logically impossible to grow out of these deficits. So the only other way to basically get out of this would be a default, or B, austerity. Obviously, both of those are not working. You saw it didn't work in Europe, and let's hope the Western world would never consider a default. Therefore, it's debasement. So we need inflation to basically remedy the debt problems in the United States, in the United Kingdom, in the European Union, in Japan. Make no mistake, these fiat currencies need to be debased. And what do I mean by debased? We need our interest rates on our debt to be below nominal growth. Otherwise, all of these economies are functionally insolvent. So again, whenever you think about, well, I might not really buy into that inflation thesis, this is the biggest limiting factor. Another strong consideration when thinking about inflation on the next slide is kind of right now, I think the market is really stuck in a area where it doesn't understand where we are between the quote soft landing and hard landing. I would argue everything leads back to inflation. So let's go onto the right-hand side and say, okay, all of these rate hikes are finally flowing through the system. You're seeing stress in real estate markets in the US. You're seeing stress in certain types of credit markets. Obviously, we had the regional banking crisis, but let's say that we see moderating cyclical inflation, credit stress, lower, maybe even negative real economic growth. Policymakers have shown you time and time again, whether it was regional banks in the US or the UK gilt crisis, they don't care if equities go down 50, 70, 80%. The second there's a credit problem, they panic. And why is that? Go back to 2008 and 2009. The big problem was contagion in credit markets through the mortgage-backed securities and collateralized loan obligations. We think that ultimately they will ease, and under a hard landing scenario, you see inflation coming back because it's really the only solution. Under the soft landing, let's assume that we still have sticky core inflation, resilient capital markets, and economic growth. That would mean status quo. So I would say that means basically acceptable economic growth and continued higher rates. I think that there's a large lag effect until that actually hits the underlying economy. So I think that will actually create a bigger economic issue, which will be met with even more stimulus, ultimately even higher resurgent inflation. To be honest, I think we're somewhere in the middle. I don't really buy into the really hard landing where the preconditions for a true crisis, I don't believe are there. I also think that it would take somewhat of a miracle to have a very smooth, moderate recession. But so anywhere in the middle, again, I think that we're in a structurally higher inflation regime for decades. Moving on to the next slide. Here's a really important concept when you think about hard assets. So this was popularized by Jeremy Hosking and Ed Chancellor at Marathon Partners, but it's called the capital cycle theory. So if you look at the bottom left there, this is kind of where your returns are and where the capital is. Returns are horrible. So let's say something like iron ore coming out of the global financial crisis. Absolutely nobody was willing to invest because the returns were horrible, if not negative. So capital comes out of that industry. ESG is a factor, poor returns is a factor, indexation is a factor. But lo and behold, as there's starvation of capital in that industry, actually coal's a better example, the returns gradually start to increase. And you can see that as those returns start to increase, capital does start to be attracted back into the industry, ultimately getting back up to a peak where there's too much capital and that capital chases away those returns and you go back into another capital down cycle. Typically, this would happen in 7-year cycles. The really important factor is in this cycle, capital is not returning. And I have a slide on this a little bit later. But moving on to the next slide, it's really important to understand how to play these cycles, because if that blue line is where we think the asset cycle is going, the actual market path is more like that dotted gray line. So you really need to own very high quality businesses that can withstand the volatility in that cycle. I think that we're maybe a third, if not only 20% of the way through the asset cycle, and equities are maybe 10% of the way there because equities still haven't bought into the narrative that assets and hard assets and commodity is going to be very important again. But that's why you need the appropriate business model to basically own through this cycle. Going into a metallurgical coal producer that's levered up 10 times, if anything goes wrong, you have a big problem as an equity holder. Moving on to the next slide. This again goes to that capital cycle theory. So if you see the gray line, that's on the left-hand side. That's the balance sheet assets of the energy companies in the S&P 500. You can see, even though we've had inflation, higher energy prices, higher oil field service costs, we kind of peaked out with our total balance sheet assets in 2014. You see return on assets, which is plotted on the right, actually was negative for quite a while after that. It actually stayed very negative through 2020. Now we're actually at the highest return on assets that the energy sector has seen in 20 years, but assets are not returning to the industry. That's because CEOs have been told by their investors, if you reinvest, we are going to sell your stock, because investors in energy are fed up with them chasing poor returning projects. By definition, this will increase the return on remaining projects. Moving on to slide 10. This is, again, really important, the equity to commodity ratio. So if you think about capital markets, this plots the S&P 500 divided by the Goldman Sachs commodity index. So going into the tech bubble, which is that big peak in the middle, when the NASDAQ went kind of parabolic into blow-off mode, you got up to a ratio of about 10 to 1. That's these equities relative to commodities. You went all the way down to the bottom of this cycle to about 2 to 1, a little bit less. Then you actually ran back up through the bubble, which I would say culminated in late 2021, where we got back up to 10. You can see we started to mean revert about halfway back to the mean. However, with this latest run of the NASDAQ and sell-off in commodities, you're actually all the way back at these historically unprecedented levels. But just to go back to the long-term average of about 3.5 from about 9 today, you would need several multiples of outperformance of commodities relative to equities. And again, I think that longer term, this cycle will probably mean revert and maybe even go well below that if history is any indication. Moving on to slide 11. This again shows you another big part of supply. So everybody today is focused with demand, worried about what the recession is going to look like, worried about how long the Fed is going to continue to keep rates high and how long to hike. Nobody's paying attention to the supply side. Look at all of the inventories of critical metals, food, and energy inputs relative to the 5-year median. So nickel, copper, aluminum, and zinc, anywhere from 70 to 40% below 5-year medians. The reason these 4 are so important, those are 4 of the most important metals for the electrification of the global power grid. So if the world is serious, which they are, and we're committing trillions of dollars to decarbonizing primarily through electrification, we're going to need as much as 100% more copper and many multiples more zinc and aluminum and nickel. But the inventories have been depleted because nobody's committing the capital to actually get it out of the ground. So we could see scenarios or actually stagflation because there's a political impetus where fiscal is going to dominate monetary policy, particularly around this EV transition and electrification, which, by the way, front loads a lot of crude oil, gas oil, and that gas consumption as well. So another big structural factor here is inventories. Slide 12. So again, this is kind of the current market structure and what we're seeing, some inconsistencies across asset classes. First one is the NASDAQ 100 versus the 2-year Treasury. It's very clear that growth stocks, in particular the large cap tech complex, is trading as an interest rate proxy. So you can see on the left when the 2-year treasury went basically to zero, the NASDAQ, after reaching a bottoming process, went on just a huge tear, which basically doubled off of pre-pandemic levels over the course of the next 12 to 18 months. But then you can see the NASDAQ peaked out in late 2021 when they realized the Fed was actually serious and the Fed starts hiking rates. So the NASDAQ goes from an index level of about 400 to 250. As basically the market digests and starts to believe that rates are kind of reaching a terminal value, the NASDAQ kind of starts to mean revert and kind of find a new range. Then it really breaks out after Silicon Valley Bank collapsed in the first quarter of this year. The really bizarre thing, though, is we've actually seen terminal rates increase. So look at that gray line on the far right. The 2-year has actually gone, US 2-year treasury has gone from 4 to 5. Normally, we would expect the NASDAQ to actually go the other way and go down, whereas it's actually correlating at 1 again. So the market is trading in a pre-2020 world where bonds and equities are positively correlated again. I think that that is radically unlikely to exist, because that can only exist in a world where rates are ultimately going to go down and inflation is going to be permanently remedied. So that, I think, I'd add a lot of caution around NASDAQ exposure based on that variable. But I think slide 14 actually adds a lot of context to that. If we can move on to 14, please. So this is the expectations of where rates are going to be. So remember, all of these equities, whether it's venture capital, private tech, public tech, anything, the value of these companies, because they're growing so rapidly, and especially if they're not generating cash flow today, is so heavily backweighted. So this is the Atlanta Federal Reserve Bank. This is their Fed funds expectation tool. It uses Eurodollar, LIBOR, and Treasury futures to basically forecast what the market is saying interest rates are going to be. So if you can look here, right now, short-term rates are around 5.5%. The market is telling you by the end of next year, we're going to be down to 4%. So the market's still pricing in, this is as of yesterday, before the dot plots, I should add, is going to be down to 4%. The market is trading long duration equities on expectations of long and sustaining cuts. You can see going all the way out to 26, we're pricing all the way down to 350, maybe even 300 basis points. So again, do not underestimate, and you absolutely have to consider the rate sensitivity of the stock market today to rates. Slide 15, I think, shows another really good indication where the bond market is saying something completely opposite. So with equities trading near all-time highs and record earnings growth expectations after kind of a flat to down year, this is the 10-2 Treasury yield curve. So in a normal, healthy environment, obviously you get paid more in a 10-year versus a 2-year bond. We're at negative 100 basis points. That means you get about 5% in a 2-year bond versus 4% in a 10-year bond. That typically is only in markets where you are expecting a severe recession and rate cuts going forward. So the bond market is saying something really nasty is coming. The equity market is saying, I think everything's fine. We're going to have a soft landing. Who knows who's right, but ultimately tech stocks seem to be trading more on rate expectations than fundamentals. But cash flow is far more important than rates, in my opinion, especially when you run a proper valuation model. Moving on to 16. This is a really important chart as well. It's a little hard to understand, but it's from Bank of America Global Research. It shows you past cycles where the relative performance of the leading sector relative to the previous market cycle leader. So I think the most pronounced, obviously, as you could see in the purple there, technology relative to energy. So technology basically took over as the new market leader, beating energy by a factor of 7-fold going into 2000. So again, $1 invested or $100 invested into energy would become 700 relative to 100 in energy between 1990 and 2000. If you go to the bottom right of that blue, it actually gave all of that back. So if you look at kind of the gray line, that's energy tech, where basically technology again kind of took over as the leader of this cycle coming out of the '09 bottom. Now we are seeing a new leadership. We don't know what the new leading sector would be, but if that red line is any indication, if you were to swap in energy or materials instead of tech, I think that we're forming what is now going to be a 5, 7, 10-year leadership cycle of the new market leader, which, depending on which one of those graphs you want to look at, could be anywhere from 4, 5, 7 times outperformance of that sector relative to tech, which is the prior leader. So just wrapping up in a couple slides here, moving on to 17. Why hard asset and why capital light? So I think we've already established why we think it's going to be really important to have exposure to hard assets. But you also need high quality businesses. So you need capital light businesses resulting in high operating margins, operating leverage, and minimal debt through a full cycle. So we're not trying to time a cycle here. We're trying to find a full cycle or multi-cycle exposure to the best quality businesses, but ultimately it has to be in durable assets. Critically, you need high quality, which is mean low on the cost curve and long reserve life, because we want to benefit from this over many decades. Again, valuation is king. If you're not paying the proper valuation, then you're not necessarily, it's really hard to benefit from an asset. Our strategy and my fund, we have higher and rising profits, a lower valuation, less debt, and faster sales growth compared to the S&P 500 in hard asset companies. We also want non-binary returns. So the return profile of the companies did not require higher prices and inflation. This is really important. So a lot of strategies that focus on real assets are indirectly making a direct bet on oil, gas, fertilizer, wheat, or interest rates or real estate. These companies generally have 8, 10, 12, 14% underlying returns under the status quo. Lastly, and critically for particularly this group, is diversification. Major global indices have effectively no exposure to these sub-industries because, again, global market indices are market cap weighted. So today, the entire S&P 500 is being driven by mega cap tech stocks, where if you removed 7 stocks, the index would be flat for the year instead of up 15%. So we think that these types of companies provide a lot of diversification and very complementary exposure to what would be a standard indexed exposure that today, given the construct of indices, skews to be very large cap and very tech focused. So with that, that's kind of my summary on the thesis, kind of what we're doing and why. And I'm sure Rajeev has plenty of questions and, happy to kind of dive into examples of exactly what hard asset capital light companies are in the Q&A, but I'd like to leave a decent amount of Q&A from here. But again, thanks for listening and happy to dive into any of these points.
Thank you. Brilliant. So let's start off with the most obvious question, right? So, NASDAQ is now at 32% more. And, what I heard you predict is basically that tech is going to underperform, going forward, right? And, had a 30-year highest move up. So is this like a crack up boom? Is that what we are seeing at this point in time? Property holding up, stock holding up, emerging markets holding up. And when does this environment sort of change, to the reality that you have sort of mentioned or alluded to in your charts?
So I think that there's a lot of technical factors that are driving the price performance this year. So if you go back to the beginning of this year, right away, you saw technology stocks outperform, which seemed more of a mean reversion technical trade. So nobody was expecting fundamentals to improve. There was really no justification for that other than a technical positioning-based trade. I think something that's been really interesting as the year has progressed, particularly after the regional banking crisis in the US, is that originally there was an expectation of lower terminal value on rates. That's actually gone up. So all else equal, the valuations have gotten more stretched on kind of these larger, more richly expensive stocks. But I think the number one variable that shows you this is more of a positioning and technical trade than an actual fundamental trade is that the lower quality profitless tech companies, so the Goldman Sachs profitless tech index, that's still about 60% off of its all-time high when the NASDAQ is right around its all-time high. So the market is telling you, I only trust quality and I only trust liquidity. So talking to a lot of investors at hedge funds that are a lot more tactical and a lot more short-term oriented, there's so much uncertainty this year. Nobody knows what inflation is going to do, what interest rates are going to do, what the economy is going to do. And I think it's just a very, very crowded trade thinking that Microsoft and Adobe and Amazon are safe havens because of the business models. So it's not necessarily me saying that I think that they're bad businesses or they're extremely overvalued. I think they're pricing in the perfection of a soft landing and a return to the 2019 world. So large cap tech is pricing in a very soft landing to where their earnings are not impacted whatsoever by whatever the recession looks like. Extremely low probability to that. But then also, and more importantly, we're going back to a 2019 world where we're going to have structurally very low interest rates and very low inflation. Again, I think that's a very heroic assumption. If all three of those variables do come to fruition, perhaps large cap tech is going to be a reasonable investment. Short of that, I think that obviously these stocks are going to be very challenged and that there's far more value in other sectors. So again, just to clarify, we're not calling for any type of crash, particularly in large quality tech. I think there's areas of the market that are far more vulnerable, as you alluded to, commercial real estate. I just think that the risk reward there, given how quickly we've moved with no fundamental improvement in most cases, is certainly concerning and far more technical than fundamental.
Interesting. I think the next question, and I'm going to come back to this at some point in time, James, but we speak about inflation as being structurally, up there. And at the same breath, we are staring down at commodities like crude, iron, copper, which have seen more than a 25-30% slump over the last 12 months, right? So where exactly is this inflation, at this point in time, and why isn't it biting? See, the economies have sort of shot up. If I look at India itself, our growth rate is perhaps the highest in the planet at this point in time in terms of large economies per se. We are at, I think, 7.5%, whatever, which means that all commodities should be, coming out. China has now come out of the COVID recession. That should be really leading to more demand in there. And yet, the stocks are sort of down. And you mentioned the fact that inventories have gone down as well. So why isn't this reflecting in the prices of the commodities across the board?
Well, I think there's a couple of reasons. The biggest one is, as you alluded to, is China. And so everybody expected that once China lifted their zero COVID policy, they were going to flick a light switch and the economy was going to turn on instantly. That's just not practically how things work. Obviously, it takes months, if not possibly years, to get the entire Chinese economy back up and running. But make no mistake, the Chinese reopening has been a disappointment on a variety of metrics. And part of that is that Xi is trying to shift his economy from an investment-based economy, so building bridges and roads and buildings, to a consumption-based economy. That is very difficult, especially after they crushed the psychology of the Chinese investor last year between curbing property prices, cracking down on large cap technology, and cracking down on for-profit education. So I think that the party is going to have to really figure out, how do we reinvigorate the animal spirits and get individuals to consume, meanwhile adding in some fiscal where they do have to add some support on the investment side. You can't just switch from an investment-driven economy to a consumption-based economy overnight. They appear to realize that and be starting down that path. Another huge factor there is interest rates. And so just like everything else, interest rates are gravity on financial assets, and commodities are no different. We have seen, and Goldman Sachs research supports this, as well as a number of other banks, we've seen one of the greatest destocking of commodity inventories in the history of mankind. Now, you would say if you're China or India or any other growing country that needs these resources, why on earth would you be destocking? Well, it went from being 1% or less for you to finance those inventories to 6%. So if you think about how important that 5% of extra cost is to finance that inventory, you now are basically saying, look, let me monetize this. So that has really flooded the market. The third biggest variable has been fears of a recession. So any macro investor I speak to is just full of doom and gloom, as they have been for 10 years now. And they're very fearful about the leverage in the system, the potential of a recession. And then they say, well, okay, where's the most liquid market? The most liquid commodities are iron ore and crude. And so that's where they express. If you look at the short interest on the commitment of traders report for US and Brent crude, it is the lowest it has been in 40 years, lower than 2008, lower than March of 2020. That shows you how extreme the speculative positioning is in these commodities, because that's how they want to express a recession view. But it's not fundamental. It's just where the liquidity is. There's not enough liquidity in other areas. But this might surprise you. In 2008 and 2009, global oil consumption only fell a total of about 1.5%. We actually eclipsed 2007 consumption levels by 2010. That shows you how inelastic demand is, particularly the non-OECD world led by China and India actually grew consumption throughout. So as long as the non-OECD world continues to pursue higher income per capita, energy growth is going to grow. Energy growth per capita is a constant with GDP growth per capita. So again, I think that there's so many structural technical factors that are clouding the view, coupled with this inventory destocking and the China, where it's kind of like we've thrown everything possible to knock down these commodity prices. And $75 Brent and $3.50 copper and $100 iron, these are not recessionary falling off a cliff level. So I think that shows you the resilience in the market. And once these factors kind of crack, I think that there's the potential for a pretty steep snapback.
Got it. And I think that was a very concise explanation. Loved it. If the liquidity, cycle argument is holding for the commodity markets, why is it that the same liquidity cycle argument is driving, driving the stocks, going higher, right? Shouldn't the thing be playing out in both the asset classes per se? Because liquidity is liquidity, right? It doesn't see where it needs to go.
Yeah, that's also a really good point. And so the thing with commodities is there's a carrying cost to your inventory. So that's kind of a direct cost. With stocks, if there's extra capital in the system, which, believe it or not, if you look at different measures of Fed liquidity, there has been draining liquidity, but based on some other measures, we've actually seen some increasing liquidity. So interest rates and liquidity are two very different factors. Interest rates directly impact a carry trade if you're trying to carry a commodity or a physical good or a physical asset. Whereas extra liquidity in the system, when you have that liquidity, you're basically competing between short-term bonds, equities, and any other financial asset. That has continued to find its way into stocks, which I've been surprised given the fact that you're competing with 5% short-term rates. But again, there's a lot of people that do really good work on liquidity coming into and out of the system outside of traditional fiscal means. So whether it's money market funds or the Treasury General account or reverse repo markets, but the Fed has been very deliberate in making sure there was liquidity, particularly after the regional banking crisis. Exactly. And so you're not going to see that in your headline fiscal and monetary numbers, but those underlying numbers in repo, money market, Treasury General account, that has definitely been flowing into the economy, flowing into financial assets, and certainly flowing into large liquid equities.
Got it. I think, great point there, James, which brings us to the question of interest rates. And I know, it's a sign of the uncertainty of the times today that three of the largest central banks have taken three exactly different opposite positions, right? The Americans have gone on hold, the Eurozone has raised, and the Chinese have cut. Right. So, I mean, given this, I mean, if the central banks are finding it so difficult to understand the economy, and they are the ones that can print the money, right? Everybody else has to aggregate or grab the money from somebody else or something else that needs to happen. What exactly is happening, and why is there so much? I mean, from the thesis that you laid out, it is pretty much crystal clear what is going to happen, right? Why is there so much of a dichotomy in the way these three large banks have reacted? What do you think is happening?
Yeah, great question. And I think that the biggest theme is that there's a decoupling of the global economy where it's no longer it's a multipolar world, and it's no longer America and the West leads every economic cycle. If anything, I think that the tail might be wagging the dog here. But in the United States, there was very, very strong political pressure to start hiking interest rates far earlier. So I don't think that the Fed wanted to raise rates when they did, even though they should have. They should have done it even earlier. But the US started hiking much earlier. So we had a huge head start on Europe. Meanwhile, China, for whatever reason, was continuing to go through their zero COVID lockdowns. So China's basically already had their recession. And as I mentioned before, they're really struggling to get that economy back into high gear, whether it's psychological or switching to consumption. Europe's kind of in the middle, where Europe was way behind the US in starting to hike rates. A year ago, everybody thought Europe was basically going to freeze. Not a year ago, but last fall, remember, everybody thought Europe was going to freeze because they weren't going to have enough natural gas after Nord Stream. Lo and behold, we had the warmest winter on record, and we've actually seen some shockingly strong economic data coming out of Europe. So I think the European central banks were correct in being very measured about their interest rate hikes. But now, if you look at UK inflation, you're 8 or 9%. Different measures within mainland Europe are equal, but Europe's going to have a very, very tricky situation here, because if we get a second run in this commodity cycle, Europe is structurally net short energy, materials, fertilizers, and ags. So Europe could be in a really, really tricky place from a policy standpoint, where I think that they're not really in control of their own destiny the way that other economies, like the US, I think right now is very concerned about core inflation. But again, the big limiting factor, regardless of which economy you are, is that if you're running $1 trillion+ deficits in the US and your debt to GDP is 140%, well, we brought it down obviously because of inflation, you structurally just cannot absorb these types of rates forever. So I think that there's a very good explanation for why those three banks have different policies. But again, everybody ultimately will have the same limiting factors, which is why we see structural volatile inflation as the end game.
Great. Thank you so much, James. One subsequent question, and this perhaps has got some vested interest for us in India, right? So global investors are sort of, they've been looking at China for a very long time as a source or as a destination for their investments, right? The government bonds in China, for instance, a steady source of secure returns during the pandemic years, et cetera, and monetary tightening is at this point in time happening in China. So, do you sense that given the way the geopolitics are playing out, the fact that the US is going into the election cycle, which is going to mean much more anti-China rhetoric very clearly, and the fact that there are not too many other investable places, do you sense that there is going to be a bigger wave of money that's pouring into geographies like India? Obviously, we have ourselves, after our prime minister visited the US a month ago, we've seen a significant amount of foreign portfolio investments rising in the country automatically, right? What do you sense is happening in there? I mean, is there an alternative to China sort of coming into play at this point in time? Full marks if you get the correct answer.
Yeah.
Just kidding.
So my firm, and I've been here since 2005, we were very early in investing in emerging markets going back to over 20 years now. And I remember in 2005, us struggling and being frustrated by how closed Indian capital markets were, where, believe it or not, as recently as 2005, many of our custodians, institutional hedge fund custodians, could not even hold and transact in Indian capital markets. Virtually no retail platforms in the United States are able to transact directly in Indian stocks. And so I think, I'm not sure if there's I'm the furthest thing on earth from a geopolitical expert, but given my experience, given the incredibly compelling fundamentals of India, both from a rising GDP per capita, demographic, the rising component of an educated workforce, it's such a compelling macro story that if you liberalized your capital markets and enabled Westerners to invest more directly, I think there would be an enormous wave of capital, but it's outside of my expertise. I honestly don't know why they've been so slow in doing that. And, if you look at ADR and GDR listings of Indian companies in London and the US, they've done very well. So I would love to see a liberalization of markets in the NSE, et cetera. And I think that capital markets and valuations would be rewarded dramatically if they were able to do that effectively.
Great. I want to touch upon some of the traditional questions that you would get asked anyway, James, right now. One of those has to do with the dollar, right? So, the dollar has sort of, sort of been yo-yoing. It's at, I think at this point in time, something like 103 something, right? So DXY is at 103.26. It's sort of, double topping almost, right? In some senses in terms of what it's doing there. What is your sense of the, you also mentioned the fact that there is this, unraveling of the global economy that's happening. Do you think the de-dollarization is also a trend there? And if so, what do you see happening there? I'm not for a moment arguing that the dollar is going to lose its reserve status currency here. I don't think that's on the cards, at least not as far as I'm concerned. But what happens in terms of the DXY or the US dollar's demand going forward?
Yeah, so I think that what people don't understand is the dollar will remain the global reserve currency because there is no alternative. You hear about the BRICS currency, you hear about you can't use the yuan. There's really no alternative, and I don't necessarily see one for a while. But you can also have the dollar being debased while being the global reserve currency for transactions. So what does that mean? That means that real stores of value go up against the dollar, against the yen, against the euro, against the pound, because if we're adding 7, 8, 10% of dollars into the money supply every year, in 2020, we added 40% more dollars, where something like 70% of all dollars in circulation have been added to the system in the last decade. Why on earth, if you are, working in Indonesia or Malaysia or India for that matter, would you say, hey, I want to own more of that currency? So I think that narrative is extremely bullish for gold, because gold, I think, is the most natural store of value. There's some great capital light companies and royalties that have gold exposure, but also every other store of value. If the world's going to electrify, we need copper. I think that the world is going to demand, I think we're going to grow oil demand for at least another 7 to 10 years. And then at worst plateau for another 10 years before going into a very gradual decline. Look, we can't get off coal, and we've been telling you that we were going to stop consuming coal for a decade now. So that's why I think the hard asset thesis is so compelling, because even if the US Treasury is willing to pay you 3 or 4 or 5%, if money supply growth is going to be 3 or 4 or 5%, you're basically getting nothing. And if your purchasing power is basically going nowhere, you need to own something that's actually going to store value. And not to go down this rabbit hole, but I think that's why you're seeing more and more people understand the theoretical benefits of crypto, where I couldn't believe how aggressive Larry Fink was yesterday, talking about the need for democratization of Bitcoin and the need for Bitcoin ETFs. But it all comes back to your point about, where is the store of value in a currency? And I would say it doesn't exist in traditional fiats anymore. And, I think the first outlet is going to be gold, but then kind of some of these other stores of value.
Great, but gold has been one of those commodities that has burnt pretty much everybody that it has touched. So, one would be a little wary, one would presume in sort of going in there, though the last year has been pretty good for it. Just in terms of the broader, so from what I understand, James, don't hold cash, right? That's clearly, one, because it's fiat and it's subject to debasement. Would you also say don't hold bonds? Because at this point in time, bonds do seem to be yielding pretty good numbers. And that once the inversion actually sort of, plays through, the chances are that the bond values will sort of rise substantially as well. So is that what you're seeing, in terms of, let's just run through each of the assets and say hold, no hold kind of a thing?
Avoid duration. So you can hold cash tactically waiting for a better opportunity. I think right now, particularly in traditional stocks and bonds, there's nothing that compelling given where valuations are. So I have a lot of my personal money rolling at almost 6% in short-term deposits. I think that's a great tactical allocation, but I certainly would not be in 10-year, 20-year, 30-year bonds as a staple of my portfolio. So do not hold your traditional 7-year average weighted maturity bonds that you would think about in a 60-40 sense. Cash, do not hold it structure as a feature of your portfolio. Hold it as a tactical feature, saying I'm waiting for a better opportunity. When I find it and when valuations come back, I'm going there.
And what about the other assets? So, I think commercial real estate is clearly no hold, right? As far as you're concerned, at least in the US.
Yeah, again, unless there's something incredibly compelling from a valuation standpoint, but certainly office, I think, has a lot more pain. I think multifamily has more pain. Real estate's just going to be really tricky, but just like venture capital, I hate to use this word, but there are unicorns out there that are going to perform. So are there certain pieces of real estate? Yes. From a top-down standpoint, I think it's going to be really, really difficult. I'd certainly prefer global listed infrastructure, but valuation is going to be critical there, where a lot of global listed infrastructure trades like bonds now because of the interest rate sensitivity. So, I feel like I'm copping out on answering your question directly, but it really comes down to the specific asset. But from a top-down standpoint, I would say no to either of those.
Excellent. And of course, commodities is an absolute yes, must have, clearly. Would you say the same of commodity stocks as well? And would you sort of be a little wary about those, because the gold miners have not done a fabulous job, have they?
They haven't, but I think valuations are so compelling. I mean, the capital light companies that we own, we obviously love, but your traditional gold miner, copper miner, energy explorer, the valuations are so washed out that I think that they're very compelling. And kind of a highly correlated way is I also love emerging markets. I think that given my views on the dollar, given the decoupling of Eastern economies, given the multi-decade underperformance, I think that EM certainly has a chance to break out. Obviously, it's not without its risks, but I think within the equity universe, EM is extremely compelling today and very interesting.
Great. I just want to end with a controversial question. James, who do you think is winning in the next year?
Oh boy. I think you're going to see another name come into the ring that you're not hearing right now. Let's just say I hope
red
so.
or blue.
It seems like the country is pretty fed up with policies right now, so I'm hoping that a moderate, or thinking that someone more moderate on the red side is going to come in, because I don't know what you're reading in local media, but it seems like people are not very happy with policies here and ready for some form of change. And ultimately, though, I think that you're not going to see a clean sweep, or you're going to see some sort of balance between the Senate and the House to where you're not going to see anything that extreme. But I do think that the public in the United States wants change. And I think that certainly going into the fall, there's going to be a really tricky environment for what you're going to see in capital markets, inflation, and rates. And so that's a setup for a surprise. So we will see.
Well, hopefully that comes through. Thank you so much, James. Really appreciate the time, energy, and effort, and really enjoyed the insights coming out of this. We will obviously put up the stuff, how to reach you in case, folks want to, because there is an interest for, high net worth individuals to sort of, look at American markets as I said, a safe haven diversification from our asset class here. So that's something that will be helpful as well. And we look forward to having you back in India at some point in time, hopefully face to face. So look forward, and thank you so much for spending the hour with us.
I would love that. Thank you so much for having me. And please don't hesitate to reach out if anybody has any follow-up or questions. And we have a ton of free research that we're happy to share as well.
Perfect. Thank you so much, James. Look forward. Bye-bye. Cheers.
Thank you. Take care.